The biggest threat to your investments, it isn't a market crash. Nope. It's that emotional roller coaster that's going on right inside your own head. So today, we're going to dive into that invisible force, the one that can either build up your wealth or, well, completely destroy it. Okay, just picture this. You open your favorite news app and bam, this is the first thing you see. Bloodbath, R's 11 lakh crore wipeout. I mean, come on, that sounds more like the tagline for a crazy disaster movie than a financial report, right? So be honest, how does a headline like that actually make you feel? Do you get that little knot in your stomach? That sudden desperate urge to check your portfolio like right now? Maybe even that little voice telling you to just sell everything and get out? Yeah, that feeling, that's exactly what we're going to unpack today. And that right there, that brings us straight into what I call the emotional battlefield. See, here's the big secret. Those absolutely terrifying headlines, they're not some kind of public service. They're a product. They are specifically engineered to make you feel scared and rushed because you know what? Fear gets clicks. Fear gets attention. And this is where the fundamental problem is. The media's business model literally thrives on getting an emotional reaction out of you. But your goal, your success as an investor, well, that depends completely on you staying rational. Those two things, they're total opposites. So the big question is, how do they actually do it? How do they build this anxiety machine? Well, let's decode it. We're going to break down 3 specific tactics that these headlines use to get right inside your head. All right, so these are the 3 main weapons in their arsenal. First up, they use these huge, scary-sounding absolute numbers. Second, they frame what are really just temporary drops as if there's some permanent destruction of all your wealth. And third, they use language that sounds like it's straight out of a war zone. Let's dig into each one. Okay, let's start with tactic number 1, using absolute numbers. So you'll see a headline that screams, Sensex drops 1,800 points. And yeah, that sounds absolutely terrifying. But let's put it in perspective. If the index is trading around, say, 74,000, that 1,800 points is just a 2.4% move. That's a pretty normal day. Quoting points instead of percentages, it's literally the oldest trick in the book to create panic out of, well, nothing. All right, tactic number 2. This is a big one. They make these temporary on-screen losses feel permanent. When they use a word like wipeout, they want you to think your wealth has just vanished, poof, gone forever. But it hasn't. It's just a number on a screen. This whole thing plays on a powerful psychological trick our brains play on us called loss aversion. Basically, the pain of losing feels way, way worse, like twice as bad as the joy of gaining the same amount. It's what we call an unrealized loss, and it only becomes a real loss if you let that scary headline panic you into selling. And finally, tactic number 3, the words themselves. I mean, just listen to them. Bloodbath, crash, wipeout. These aren't financial terms. They're combat terms. They're chosen for one reason, to completely bypass your logical thinking brain and hit you right in that primal fight or flight response. And once that kicks in, you're not thinking about your long-term plan anymore. You're just thinking about how to escape. And that, my friends, is exactly when we make terrible decisions. Okay, so we've talked a lot about fear. We've decoded the fear machine, but this emotional roller coaster, it's got another peak, and it's just as dangerous. I'm talking about euphoria. This is that wild moment when the intense fear of losing money flips almost instantly into the intense fear of missing out on making money. Yep, good old FOMO. And what's crazy is how fast this happens. I mean, after just a few green days, a few good sessions, the entire narrative in the media just flips. All that panic, gone. It's replaced with this super confident, almost certain tone, like, phew, the worst is over. In your brain, it's so relieved to be out of that danger zone, it starts seeing opportunities everywhere. You see other people making money, and that social pressure, that proof, it's overwhelming. And this FOMO fuel euphoria, it leads people right into what's called the all-in mistake. Suddenly, overconfidence just takes over. People start throwing in a big lump sum of cash. They start chasing whatever hot stock everyone's talking about, and they put all their money in at once. Let me be clear. This is every bit as emotional and every bit as dangerous as panic selling. So you've got this intense fear on one side and this wild, giddy euphoria on the other. What happens when you put those two together? Well, you get trapped in what we call the investor's vicious cycle. And it looks something like this. First, fear takes over. You panic, you sell your stuff, or you stop your regular investments, your SIPs. Then, okay, there's a bit of relief. You're on the sidelines, you feel safe. But then, after a few good days, euphoria and FOMO come roaring back. You rush back in, buying at a price that's probably even higher than when you sold. And what happens if the market dips again? Pure regret. This, my friends, is the classic textbook recipe for buying high and selling low. So, the million-dollar question is, how do you break this cycle? It's so destructive. How do you finally get off this roller coaster for good? Well, it's time to build your own disciplined investing playbook. First things first, you have to change your focus. Seriously, instead of endlessly scrolling through a news app that's designed to scare you, open up your actual financial plan. Instead of listening to the panic echo chamber in your WhatsApp group, pick up the phone and talk to your advisor. And give yourself a rule, a hard boundary. You're allowed to check the market once a day. That's it. And preferably after it's closed, not while it's jumping all over the place. You know, there's this one analogy from our source material that I absolutely love because it's just so perfect. A market dip is the exact moment your systematic investment plan, your SIP, is doing its most important work. Why? Because it's buying up more units for the exact same amount of money. So pausing it then, it's literally the worst thing you could do. Okay, so here are the actual disciplined actions you can take. Number 1, keep those SIPs running. No matter what, don't touch them. Number 2, if you happen to have some extra cash you want to put in, do it gradually. Don't just throw it all in one big euphoric splash. And number 3, probably the most important of all, stick to the asset allocation plan you made back when you were calm, cool, and collected. Look, if there's one thing you take away from all this, let it be this. The headlines are always going to be urgent. Always. That's their business model. But their urgency does not have to be your portfolio's urgency. Your portfolio isn't some breaking news story. It's a long-term project. So, at the end of the day, this is the choice every single one of us has to make. The next time you see those headlines screaming, the next time the market starts to swing wildly, who are you going to be? Are you going to be an emotional reactor getting pulled right back into their cycle? Or are you going to be a disciplined investor, someone who just sticks to the plan? The choice, really, is all yours.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully. Past performance is not indicative of future results and may not be sustained in the future. Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Insurance is a subject matter of solicitation.